Hello and welcome to Pura's weekly trading digest. Let's start with a brief overview of what was happening this week in the commodities markets. This week was generally tough for agricultural commodities because of heavy headwinds created by the US Fed's FOMC, which decided to make yet another rate hike by 25 BP, thereby amplifying the risk of environment in an anticipation of the US economic's hard landing. Although grains and soft commodities are rarely considered the cyclicals, food demand is known to be economic cycle resistant. Flight to quality in this particular episode, preemptively to gold and Bitcoin, distorted the real pricing pattern for the sector. Having said that, the Black Sea Grain Initiative remained highly in focus, which ambiguity caused excess volatility and additional uncertainty to most grain contracts' pricings. Wheat. Chicago wheat and corn futures posted weekly gains for the first time in 5 weeks, ending stronger on Friday on high demand for US corn exports and market jitters over the extension of a wartime Black Sea grain deal, which we covered during the week devotedly. Chicago Board of Trade May soft red winter wheat WK3 settled up 11.5 cents at $7.10.5 per bushel on Thursday, with the most active contact WV1 making weekly gains for the first time in 5 weeks. The US Department of Agriculture USDA made its 4th consecutive daily announcement of old crop US corn sales to China, totaling 2.1 million tons over 4 days. Corn prices have been on a rather steady downward trend in recent months. CBOT May corn CK3 settled up 1.5 cents at $6.34 per bushel, with the most active contract CV1 making weekly gains for the first time in the same period. As such, there will be a short-term volatility in the market as investors assess supply and demand dynamics, but looking ahead, corn prices could rebound as demand outstrips demand. Soybean prices were back in the red and near their lows by midday Thursday, March 23rd. Trading data showed a loss of as much as 1.95% in the previous months after an overnight Wednesday-Thursday rally faded down. Soybean oil. Soybean CME futures nosedived Thursday to a 15-month low, with downward pressures from rival vegetable oil markets, technical selling and some oversupply pressuring domestic prices lower in the US. Soy oil led the losses for the week, down 4.8% from the May contract's 52 cents per pound, the lowest level for the May BO contract since December 2021. This has been the third consecutive downfall in soy oil futures, which brought the front-month contract on a rolling basis to the lowest level since December 2021. Lean hogs. In the pork market, the April contract was up 7 cents at midday Thursday, while other front-month contracts were still down between 7 and 45 cents. The USDA national average base hog prices fell another 79 cents to $76.50 Thursday afternoon. The CME Lean Hog Index was at $78.67 on March 20th, down 88 cents. Furthermore, the USDA estimated FI hog slaughter for the week ended March 17 at 1.422 million heads, down 26,000 last week and 2,000 last year. Summary and forecast. Expectations of an unusually hot and dry summer, combined with the impact of the war in Ukraine, will probably send wheat prices surging by about 20% from current level as early as April. As there is an apparent oversupply of soybean oil, whereas soy plantings worldwide haven't been adjusted for this fallout, imminent soybean excess can damage the entire subgroup pricing. So we are now particularly bearish on this commodity, especially longer-term futures.